Let's talk about what just happened because the Bank of Canada has officially held interest rates again, and this move is a lot bigger than people realize. On the surface, it sounds simple rates held, nothing changes. But if you look a little deeper, this decision actually tells us everything about where mortgages are heading for the rest of 25 and into 2026. And honestly, most Canadians are going to miss the real meaning behind today's announcement. Here's the truth. This wasn't a surprise to people watching the data closely, but the reason that they held rates is why this matters. Some people were expecting a cut. Even a few thought a hike was possible. Instead, the bank basically said, we're staying right here. And that right there should make you pay attention. Because whether you're renewing your mortgage, holding a variable rate, planning to buy, using a HELOC, or just trying to stay afloat with rising household costs, this rate hold affects you in ways that headlines won't explain. The biggest misconception that Canadians have is this: a rate hold does not mean stability. A rate hold is a message, it's a signal. And the message the Bank of Canada sent today was very clear. We're not cutting anytime soon because the economy isn't slowing fast enough. Now, here's where things get even more interesting. Almost every major bank in Canada has now released its updated interest rate forecast for 2026. And the picture that they're painting is very different from what the public is expecting. Two of the big banks are predicting rates remain flat through 2026. Two others predict a tiny cut of 0.25% drop, basically nothing. And here's the shocker. Scotiabank actually is forecasting an increase in rates in 2026. Let that sink in. While homeowners are waiting for big cuts, some of the biggest financial institutions in the country are saying, don't count on it. And remember, this is happening in a market where inflation is still above target. Wage growth is strong, and shelter inflation is the highest of all of G7. And then you can add in the curveball that nobody expected. GDP actually grew last quarter. The economy showed more strength than forecasted, which gave the Bank of Canada zero incentive to start easing. If GDP had contracted, if we were sliding into recessionary territories, this conversation would be very different. But instead, this hold reinforces a growing reality. Rates may stay higher for longer than anyone had hoped. And that matters especially as we head into the largest mortgage renewal wave in Canadian history. So in this video, we're going to break down exactly what today's announcement means for your mortgage, what it means for the housing market, and the moves that you should be making right now to protect yourself. Because yes, the bank held, but the meaning behind that decision, that's where the real story begins. All right, now that we understand why the Bank of Canada held rates, let's get into the real fallout, because this is where things start to get uncomfortable. A rate hold means the Bank of Canada is buying time, and Canadians are the ones who feel the delay the most. Let's start with the biggest point almost nobody is talking about. This rate hold confirms that we are not in a cutting cycle. We're in a wait and see cycle, and that's a very different from what people have been hoping for. The bank is essentially saying we need more proof, more cooling, more data. And the reason is simple. They don't trust the economy yet. They don't trust inflation yet. And they definitely don't trust shelter costs, which is right now the number one barrier keeping inflation above target. Let's break down what's driving their hesitation. Inflation has cooled, but not enough. The bank doesn't care about the headline numbers. They care about core inflation, and core inflation has been stubborn. Wage growth is still too strong. Strong wages sound good, but strong wages mean continued spending power, which slows inflation cooling. Shelter inflation is still the highest in the G7. Housing costs, rent, mortgages, construction are keeping inflation elevated. Lowering rates too quickly would pour gasoline on the housing market. And GDP actually grew last quarter. This is the key. Growth gives the bank no reason to cut. You don't ease into strength, you ease into weakness. Put all of this together and the message is simple. We're not cutting until inflation is dead. Now let's talk about what that means for real Canadians. Variable rate borrowers. If you're in a variable rate, this announcement freezes your payment. They're not going up, but they're also not going down anytime soon. If you're stretched already, this hold delays relief. If you're on a static payment variable, you're still mostly paying interest. If you're on an adjustable payment, you're still at the same cost. A rate hold freezes the pain, it doesn't solve it. Now, let's talk about fixed rate borrowers. People often misunderstand this part. Fixed rates do not follow the overnight rate, they follow the bond market. Bonds have been volatile. The hold doesn't drive rates up, but it also doesn't pull them down. We're in a data-driven gridlock. Every inflation print, every GDP update, that's what determines fixed rates right now. Now let's talk about the renewal tsunami. We are heading into one of the largest renewal waves in Canadian history. Millions of Canadians moving from 1 to 2% rates into today's 4 to 5% environment. Every month without a rate cut means higher payments, more financial pressure, tougher renewals, more households are squeezed. This rate hold doesn't soften that wave, it allows it to continue building. Now let's talk about debt and HELOC users. HELOCs stay high, credit cards stay sky high, and lines of credit remain expensive. Debt-heavy households are feeling the pressure, and for many, refinancing and restructuring is becoming unavoidable. Now let's talk about the system-wide impact. This hold affects affordability, investor confidence, seller behavior, buyer psychology, construction pipelines, and the pre-construction market. It's not neutral, it's not harmless, it's the bank saying, we're not done, not even close. Now, the important part of all of this is what should you be doing right now? Because even though today's announcement wasn't the rate cut that people had hoped for, it does give you time. Time to plan, time to act, time to get ahead of one of the biggest financial decisions of your life. Because even though today's rate announcement wasn't the cut that people had hoped for, it does give you time. Time to plan, time to act, time to get ahead of your next big financial decision. If you're in a variable rate mortgage, this is your moment to review. You review your amortization, your trigger rate, your interest versus principal, your long-term plan. Consider whether a short-term fix makes sense, but make the decision based on the math, not emotion. If you're renewing in the next 12 to 18 months, this is critical. Start early. You can secure a rate hold up to 120 if rates move in the wrong direction, and it opens up refinancing, restructuring, and consolidating options before the pressure hits. If you're thinking about buying, a rate hold actually helps you. Stability equals opportunity. Sellers calm down, buyers calm down. You get a more balanced playing field. Just make sure that you get pre-approved, not pre-qualified. Now, if you're carrying debt, a rate hold gives you breathing room, but debt isn't getting cheaper. If cash flow is tight, refinancing may still be the smartest move that you can make. So this rate hold isn't the real relief that Canadians had hoped for, but it is a chance to get ahead instead of falling behind. If you want a personalized breakdown of what this means for your mortgage, your payments, your next move, let's book a call. I put a link in the description, or you can visit meetjustin.ca. Because yes, the bank held, but what you do next is what really matters. I'm Justin Chausse of the Chausse Mortgage Group, and if you found this video helpful, please like and subscribe so that it pushes it out to more people, and we can continue to make more videos like this for people like you. Thanks for watching, and I'll see you in the next video.